Okay, and welcome back. Students taking Math for Business and Finance and Math Applications, and we're doing the Summary Practice Test, Chapter 16, and we're working on the practice test question number 1, and we had done A, so we're picking up with B here, okay? And this is about the cost of goods sold. Now, the reason why I paused the video is because as I started thinking about it, and again, this is high level, okay? And can get much more in depth, but it's good to have some understanding as to what's going on so that you can see things a little bit more clearly, especially when things get a lot more complicated. Okay. The way things work here, and this is getting into a little bit of financial accounting, okay, which everybody, all business students are going to take. Okay. Well, let's say you have a business and you sell tables. Okay. Well, whether you make or you buy the table, you put it into inventory. Okay. Now, you have that furniture in inventory, right? And it's sitting out in your warehouse. But somebody walks in and they buy one of your tables. You make a sale. Okay. Well, you have to record that sale, all right? And you're recording the sale. I mean, they're paying you with, let's just say they pay with cash, and let's say, the sale was for, say, $500, all right, in sales. Okay. That's your recording the sale. Whenever you record a sale, you also have to take and make another entry to your books related to the sale in order to be able to take that item. Now, let's say that $500 table actually costs $300. Okay. Well, you have to take it out of your inventory, okay, and you put it over to what's called cost of goods sold. Okay. You're going to put it over here, right, on your income statement. Okay. The reason why is because if you have your sales less your cost of goods sold, and that gives you a gross profit, right? So that means how much did I make just on the sale of that table, and then any of that gross profit then gets used against any other selling and administrative expenses that you have, and that gives you a net income. And all of this here is a basic framework for your income statement. Okay, if you look at your income statement, you see sales less cost of goods sold, you see a gross profit, and then you see all of your other expenses that you have, and that gives you your profit or loss. Okay, so when we're looking here at the cost of goods sold, we have to think in terms of, okay, well, remember the cost of goods sold is taking the items out of inventory to put it against cost of goods sold. Well, because we're dealing with inventory, okay, what we need to do is we need to know and understand, we need to understand or know what our beginning inventory was. Okay, and then if we have, when we take and we subtract out our ending inventory, the difference between the two is our cost of goods sold. Why? Because in the beginning of, we had those 10 tables in the inventory, okay? And if our ending inventory, when we take the inventory at the end of the month, we only have 9 tables left. Why is that not writing? Okay. That means we sold 1 table. Okay. That's what was taken out of inventory, and that's what goes over to we take it out of inventory and put it over to our cost of goods sold. So whatever that dollar amount goes over there. Okay. So we start out here, our beginning inventory was $8,000, and our ending inventory is $5,000. Okay. Which means our cost of goods sold was $3,000. Okay. Now, this is on the most simplistic level. Okay. Oops, I'm sorry. I have to back up. This is on the most simplistic level. However, it's not, it's not the I started out with saying that, and this is what I mean by you start out in the beginning on a simple level, and then everything gets more and more complicated. It starts to go more in depth. I basically sat here and said, okay, I started out with 10 tables at the beginning of the month, and that was my beginning inventory. And I went and sold one table, and so at the end of the month I had 9 tables. Okay, and that means I had one table that went over to cost of goods sold, and I plugged in those numbers and I ended up with 3,000. Okay, but that is not the correct figure for the simple reason it doesn't take into consideration that during the course of the month we might have bought something. Okay, if we had 10 tables at the beginning and we had 9 tables at the end and we didn't purchase anything else in between, okay, yeah, then we only sold one table and that's what would have went into cost of goods sold. But that's not the way businesses work. Businesses start out with a beginning inventory and they start selling things. Okay, and so remember we have our sales over here. Okay, and when we make our sales we have to make that entry to take out of inventory and to put over here to cost of goods sold. Right? But now here's the catch. We're only trying to figure out what our cost of goods sold is. We're not, depending upon the items that are sold, you don't want to be doing that every single time you make a sale. I mean, think about, it works out fine if you're talking about, like cars, all right, automobiles, and you have a car lot with, 300 cars on them. It's easy to, say, okay, I sold this car and take it out of inventory and put it over to cost of goods sold. But what if you're talking about M&Ms? Okay, packages of M&Ms. I mean, you have hundreds of thousands of M&Ms, packages of M&Ms. It's not so easy to go or even like in a grocery store, okay? You have milk and bread and all these other kind of different items. It's very difficult to take it out of inventory and put it into cost of goods sold every single time that you make a sale. So what ends up happening is you start out with a beginning inventory, and yes, things are being sold, but the managers then purchase more items to replace, what was sold. So you have purchases. Okay. And we're going to add in those purchases. And in this case here, our net purchases are 18,000. Okay. So we're at 26,000 at this point in time. Okay. And so we started out with this beginning and we're adding and adding and adding. Okay, but we know that at the end of the accounting period or at the end of the month or whatever it is, that period of time, we know a lot of those items are not there anymore because we sold them. Right? So what we do is at the end of the period, we take and do an ending inventory. We actually see what was in inventory. Okay, and whatever amount that is, okay, in this case here it's $5,000. Okay, we're going to subtract out that ending inventory, okay, and that will give us, in this case here, $21,000 worth of stuff that was sold. Okay, that is what becomes our cost of goods sold. Okay, so we're at 21,000. Right? Now notice I had said we started out with just beginning inventory less ending inventory. Okay, to get a cost of goods sold. Okay? Now, I went one step further and I said, well, we have to take into consideration purchases. Okay, so we added purchases to this formula. Okay, but it can get more complicated because why? These purchases, I can have purchase returns and allowances. I can also have purchase discounts in here. Okay, so I can end up expanding that formula even more depending upon how I break down my data and my information. In this case here, given it's telling us we have net purchases, that net purchases already takes into consideration our returns and allowances and our discounts, so we don't have to think about that. Okay, excuse me. But if we did have that information, okay, let's say my purchases were actually $20,000 and I had zero for returns and allowances, but I had $2,000 for discounts. Okay, well, I would have to be able, if that's the way the data was presented to me, I would actually have to figure out that my net purchases are $18,000, which is basically what I've done down here. So the formula can keep on expanding and expanding and expanding depending upon the data that you have um, and what you need to be looking at. Okay, so with all of that said, and working on just this particular problem, the basic formula is I have a beginning inventory, and then I have to consider my purchases. I'm going to add those together, right? And whatever I get, then I'm going to subtract out my ending inventory, and that's going to give me my final cost of goods sold. Okay, so I hope that made sense. I tried to present it in a step-by-step fashion, starting at a higher level and going on to more and more, in-depth. And there are other things that can be added to this, but we're going to leave those for the accountants. Okay. But everybody who takes any kind, financial accounting, which is all the business students, you're going to see this idea again, okay? And you're going to work through it again. So, um, you know, take it for what it is, try to understand the concept and how to apply it. And if you don't get it, go ahead and rewind the video, watch it again. If you still don't understand, call and speak to an instructor or email us. And just remember that, yes, you want to get it this time. And when you do take it in financial accounting, that would be a reinforcement, of what you just learned. Okay. So it sticks into your head in order to be able to keep it there for long term when you're out in the workplace. If you just saw the information just once, it's very easy for you to forget it, and then you'd be twiddling your thumbs in the workplace saying, why did I lose my job? All right, because why? You didn't know something very, very basic. So with that said, that's B, okay? And I will pick up with the gross profit from sales in C in the next video.